Hello and welcome. Today we're diving deep into the recent strategic move by CapitaLand Ascendas REIT, or CLAR, as it fortifies its position in the competitive Singapore industrial market. This isn't just another property deal. It's a calculated maneuver by one of Asia's largest REITs to unlock embedded growth and enhance stability amidst evolving economic landscapes. We'll unpack the SD 565.8 million acquisition of three prime Singapore core assets and explore what this deal means for CLAR's future. Disclaimer: this video is created purely for informational purposes only. It is not financial advice and should not be considered as a recommendation to buy, sell, or hold any investment. Please conduct your own research or consult a licensed financial advisor before making investment decisions. CapitaLand Ascendas REIT has announced a significant proposed acquisition, a portfolio of three high-quality industrial and logistics properties in Singapore. The total purchase consideration is SD $565.8 million, totaling SD $592.6 million once all associated fees are factored in. This deal was transacted at a favorable 3.9% discount to the latest independent valuation, immediately signaling management's ability to secure assets at attractive terms. At its core, this acquisition is about reinforcing CLAR's Singapore portfolio strategy. The move is projected to be immediately accretive to DPU, boosting it by approximately 0.8% on a pro forma basis for the upcoming fiscal year. The investment strategically targets highly resilient and future-ready sectors: technology, logistics, and life sciences. The real value driver here isn't solely the initial yield. It's the structural cash flow stability and organic growth potential stemming from long leases and significant under-renting. These assets boast a weighted average lease expiry of 5.5 years, considerably enhancing the resilience of CLAR's overall income stream. Management highlighted a 15% differential between current in-place rents and prevailing market rates. This guarantees strong positive rental reversion upon lease expiry, providing an effective hedge against inflation and rising costs. This embedded growth is the powerful differentiator. This transaction increases the weighting of the stable Singapore market to 68% of CLAR's total assets under management, AUM. This defensive rebalancing is especially valuable when global economic growth forecasts are moderating. The immediate DPU accretion and the embedded growth potential firmly justify the valuation paid. Let's look at the assets. The portfolio comprises three distinct high-quality properties. Emphasize 2 Pioneer Sector 1, a ramp-up logistics property, highly sought after for direct vehicle access across multiple floors, crucial for modern supply chain management. Emphasize 2's Connection, a light industrial property, diversifying the portfolio by catering to smaller-scale manufacturing and supporting functions. Emphasize 9 Calling Sector, a high-specifications industrial property, vital for advanced manufacturing and R&D. Acquiring such properties aligns CLAR with Singapore's structural growth in innovation. Operationally, these assets are robust. They are 100% occupied by a diverse base of 19 reputable tenants in high-growth, defensive sectors. The 5.5-year WALE significantly exceeds CLAR's current overall WALE of 3.7 years, providing income certainty well into 2031. The seller, Vita Partners, swiftly divested the assets, suggesting they successfully executed a value-add strategy, stabilizing the properties with long leases before exiting to a core manager like CLAR. This validates the assets as a stabilized, de-risked core income suitable for a long-term REIT holder. Financially, the estimated NPI yield for the first year post-acquisition is 6.4% before transaction costs, translating to the 0.8% DPU accretion. While the post-cost NPI yield of 6.1% is tight compared to CLAR's corporate weighted average cost of capital, a WACC of 6.69%, the DPU accretion confirms the funding for this specific deal is lower.
The true economic value is deferred, relying heavily on that 15% rental reversion potential and built-in escalations. Upon full realization, the stabilized yield is anticipated to comfortably exceed the current WACC, transforming the deal from tight static pricing to robust long-term value creation. CLAR will finance the $592.6 million through a combination of internal resources and existing debt facilities. The gearing ratio is expected to increase only marginally, settling between 38.0% and 38.5% post-completion. This remains well below the regulatory ceiling of 45%, preserving ample balance sheet capacity for future strategic investments. CLAR also proactively manages interest rate risk, with approximately 75.9% of its debt hedged to fixed rates, insulating DPU from immediate volatility. Sustainability and ESG considerations are also paramount. CLAR has committed to ensuring all new acquisitions meet specific Green Mark certification targets. While the immediate certification status wasn't disclosed, their high specification nature suggests they are well positioned to meet modern standards. CLAR's management will need to ensure appropriate capital expenditure is budgeted to meet the required BCA Green Mark 2021 standards. In the broader market context, the Singapore high-spec industrial segment remains strong. The tight post-cost NPI yield of 6.1% reflects intense institutional competition for stable, high-quality assets. The investment is explicitly priced for embedded growth, capitalizing the asset based on its expected higher future net operating income. This reinforces the case for maintaining CLAR's premium price to NAV multiple. We must also acknowledge the key investment risks. Refinancing and interest rate risk persist despite the high fixed-rate hedge as existing debt matures. There's also execution risk for rental reversion. The entire economic justification rests on realizing that 15% upside. Finally, a macroeconomic downturn in Singapore could pressure demand for industrial space, potentially leading to lower than expected lease renewals or tenant failures. In conclusion, this $565.8 million acquisition by CapitaLand Ascendas REIT is fundamentally value accretive. It secures prime, stabilized income in CLAR's core domestic market, enhancing portfolio resilience and generating immediate earnings uplift. The ability to lock in long-term income stability while simultaneously acquiring substantial built-in organic growth is compelling. Looking long-term, the fundamentals are significantly strengthened. The structural value embedded in the below-market leases will be the primary engine for DPU growth over the next 5 years, shifting CLAR's growth reliance partly from external acquisitions to internal organic rent reversion. This positions CLAR as a robust core holding for institutional investors seeking sustainable defensive income growth in the Asia-Pacific region. Thank you for joining us for this in-depth analysis. If you found this information helpful, please like this video, share it with your network, and subscribe to our channel for more insights into the financial markets. We appreciate your support.